And 5, 4, 3, 2, and 1. Hello, everybody, and welcome to another Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets, defer hundreds of thousands to millions of dollars in capital gains tax, eliminate some estate tax, so you can create and preserve more wealth by putting time on your side versus being forced into a 1031 exchange that can be very difficult to manage. My name is Brett Swartz, and each and every episode, I'm joined by some of the best real estate, financial, wealth, and sometimes accounting minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make passive income plans achievable and also figure out some good tax flow strategies when we exit. Hey, I'm excited about our next guest. He's out of the great state of Chicago. He's a CFA, he is a CPA, and he's on a mission to help you as the real estate investor with all of your property accounting needs. How to keep clean, crystal accounting records for your property portfolio, get investors paid on time, make the most of your technology stack, and essentially be a specialist when it comes to all things real estate and investing and accounting. Please welcome to the show with me, Mark Kappelman. Mark, how are you doing, sir?
Doing great, Brett. Thanks for having me on.
Absolutely. And for our listeners getting to know you for the first time, can you give us a little bit more about your story and your current focus?
Yeah, so went to school for accounting. Didn't really know what I wanted to do, but I had a couple uncles that encouraged me that route, which I think, in hindsight, I'm glad they did. Got an accounting degree, went the CPA route because I was at Arizona State, and kind of that was the route. You either went into tax or everything else. I went everything else. Couple years into that, I'm grinding away. And then, typical real estate story. I read the book Rich Dad Poor Dad, or it seems like a typical story. And the light went off. There's a line in the book that says, "Why climb the corporate ladder when you can own the ladder?" And I just had never thought about it that way my whole life, my upbringing. God bless my parents, but it was just go get a good job, work your way up the ladder. And that was the whole thinking. That line totally threw me for a loop. And so, fast forward a couple years, I couldn't get it out of my head. My wife and I started flipping real estate, started flipping houses, and then we started building houses. But then along came this 6-flat deal that, my business partner took a look at. He's like, "Hey, we should make an offer on this. It's an REO. We offered way less than they were asking. Somehow we picked up this deal on the cheap, 6-unit in Chicago, good area, typical story, bad property in a great area. Fixed it up. And, got commercial non-recourse Fannie debt, and the refi proceeds exceeded all the money we had into the deal. So we got the big cash out, non-taxable cash refi. My balance sheet completely changed, and I was like, holy cow. And so from then on, it was commercial real estate, really keep focusing on that. And so, at the same time I was doing all this real estate, I was still working a W-2 job. Both my wife and I were accountants, actually. Both working still at W-2. The side hustle was growing, which was cool, but it was creating a lot more work. And all the entrepreneurship books that I was reading said, "Hey, look, outsource your admin, focus on growing revenue." And that revenue was more deals, more properties. And admin for me, even though I'm an accountant, was in my real estate business was accounting. So I outsourced it thinking, all right, I'll just hire some general accountant that I found online. He or she will do great. Sounded simple, but it wasn't great. It was really bad. I actually did it twice. It came back really bad both times. He just didn't understand things like, how to book a purchase, how to book a sale, 1031, of putting a deferred gain on a balance sheet. And yeah, I probably had high expectations as a CPA, but it was just deer in the headlights with these people had never seen closing statements. And that's where it kind of dawned on us, hey, look, there's specialists in every industry. There's specialists within law. There's specialists within medicine. There's specialists within engineering. And you could probably go all the way down the line. So then we said, well, who's specialized in real estate, accounting, and bookkeeping? And couldn't really find anybody that was from our standpoint. And that's really where the idea for RIA came from. We had the problem, couldn't find a good way to address it, thought we were uniquely qualified to address it since we were accountants, then became real estate people, and then now we're real estate accountants. So that's kind of how we got to where I am today.
Amazing, Mark. By the way, you can learn more about Mark Kappelman by going to rea.co. So, Mark, I love that story. I love that origin story, and I love that you saw a need and you were a part of it as an investor, and not just a specialist. And now you're a specialist as an investor. I think that's honestly some of the best ways to help people is when you're in their shoes doing the thing that they're doing,
Exactly.
right? And rather than just being the specialist, right? It actually brings a level of empathy and a level of expertise that is that's unmatched, right? So I love what you're doing there. Before we dive into how to scale your real estate accounting, I want to take one other step back. I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. Some people call them superpowers. I think they're God-given gifts. Hey, I'm curious, what would you say is the one or two gifts that you believe you were given, and how does that help how you help and bless people today?
Wow. I think I am a great leader of big groups of people. And that doesn't mean within the social setting, I'm the funniest guy of the life of the party every time. But when I get into a business setting and I've consistently led big teams my whole life. And I think, people have told me, hey, we love the way you manage and the way you lead and we embody. So I do think that's probably one of my superpowers. And when I think of non-business, if we want to go that route, it's just being a fun guy and being a man of action. And I play a million different sports, constantly playing with my kids. I'm always kind of the life of that party of the big kid hanging out with the little kids. And so I think just I get so much joy out of it. And that's probably just the things that come naturally to me that cause a lot of joy.
I love it, Mark. Cool. Now let's dive right into the topic of big hand with those things in mind. Scale your real estate accounting. So, Mark, what is the number one secret to scaling your real estate accounting?
Number one secret has to be really understanding the industry and what's happening. And, really kind of, for us, it's focusing on the outcomes. So what I always tell people is, hey, look, accounting in and of itself is not terribly complex once you actually really learn and get educated, right? Maybe it is in the beginning, but it's becoming about is like, what are the actual outcomes? So all of our clients are property management companies, almost exclusively. Now, I should say 65% of our clients actually own and manage it. We call them owner operators, but just really dialing in on, what are the actually outcomes we're going for? The outcomes are reports delivered to the LPs on time, every time, the financials delivered to the tax accountant on time and actually right. Keeping up with bills, reconciling the banks every month, but doing all of these things timely. For me, there's no magic wand. It's just what we've built at REIA is a scalable system to say, look, we know what the 6 or 7 outputs are. Don't think about hiring a person. Think about hiring a service that is delivering outcomes. And that's what we're just hyper focused on. And that usually resonates with real estate people because it's just, they've got a problem and it's solved by problem. And we know the problems are those outputs we're talking about.
Absolutely. I love the way you put that. Think about hiring a service delivering outcomes, right? And it's not just, of course, it means hiring a who, right?
Yeah.
Being the how. And so it sounds like your main ideal client or the ones you're most serving are either property managers themselves or owner operators who are managing and doing the accounting themselves. Which leads into the second question, which is what's the number two secret to how to scale your real estate accounting?
Partnering with the right group, probably. I think, a lot of people come to us with, hey, look, I just don't want to have to hire an army of accountants. COVID changed a lot of things. We started the company in late 18, early 19, and it was just, we had this kind of, we're outsourced remote by design, and quickly everybody was forced to get into that action. And then everybody kind of, within a few months realized, oh, my accountant doesn't have to be down the hall, or my accountant doesn't have to live in my city. And so I think, if you're a real estate investor or a property manager that really wants to scale, you need to partner with somebody that can scale just as fast. And if you've run a business and owned a business, you know that scaling headcount is kind of one of the hardest things. Like scaling revenue is the hardest, but then the second hardest is scaling headcount. When you partner with somebody like us, who's scaling probably just as fast as you are as a scaling client, we can kind of keep up with that growth.
Yeah, that makes sense. Yeah, partnering with the right group, and understanding and having the mindset that doesn't have to be just local. It can be remote, and more than that, you're probably going to get a higher level of expertise. I think about on the healthcare industry, you might need to go to a special brain surgeon at the Mayo Clinic in Florida, or at this, the Stanford University for this particular cancer research. I mean, the more specialized you get, it tends to be less local folks, which means you probably need a more specialized, which by definition is probably not hyper local. It can be online. Is that a fair summary?
Yeah, it's a fair summary, and it's kind of precisely why, I wish that our management team was all in Chicago where I'm at in an office. But the reality is if you want to hire the best property accountants and you want to cast the biggest, widest net, you would benefit yourself by not just restricting yourself to Chicago. And so we do the same thing. It's exactly what you're saying.
I love it. What is the number 3 secret to scaling your real estate accounting? Maybe take it from the perspective of the the owner who has 2 to 3, it has 1,000 units, or 1,000 multifamily units, right? And they have their local accountant who's doing it, right? And now they're going, wow, this just seems daunting to transition to somebody new. Walk them through how easy it may be working with you guys to be able to transition that.
Yeah, it's really, we do it all the time. And so, yes, having a transition period is great, but I think it's really all about, look, this is coming from an accountant, but I think that our most successful clients are owners that know what's going on with the accounting and actually care what's going on with the accounting. And so there's a group of owners out there, which some people are wildly successful, by the way, but just want to turn a blind eye to accounting and go, I don't know, like, let them deal with my accountant handles all that. The reality is like, that's how you get into trouble. That's how you get big surprises. And I think if you're not willing to kind of lean in, so I just always say, and this is kind of why, part of my story is my uncles that encouraged me to go into accounting. They always said, hey, look, you don't know what you want to do in business, but you want to go into business. Accounting's the language of business. It's the one thing that everybody can equate to is numbers. Like, everybody understood. You don't know English, Spanish, but numbers are numbers. And so I just think that owners really leaning in and spending the time to understand what is the status of your bank reconciliations is, as simple as that sounds, but it's foundational. What is your AP process? How is that working? What's your financial close process? Like, you don't need to do it all, but I think you have to generally know what's going on in the cadences and the flow of the business.
Excellent. I'm curious, like, how would you define scaling it? If someone's saying, well, I feel like I'm getting that stuff done now, Mark, like be more specific when you're going towards the real estate aspect of being a specialist, in the sense that how are you going to streamline and maybe save someone time and energy, and I guess peace of mind with your guys' expertise? Walk me through the traditional client before, and maybe they don't even know what they don't know that they need or want.
Yeah.
And then a year or two later, they're like, oh my goodness, I can't believe how much, time, energy, or what is it that you're delivering is what I mean.
Yeah. I mean, I think one of the first just really big wins that we help do is, so our clients, the vast majority of them are using one of 2 systems. We cover all the systems, but it's AppFolio and it's Yardi. It's not QuickBooks, so QuickBooks, yes, like maybe for their corporate accounting, but big property managers are using AppFolio, Yardi, Entrata, Resman, these kind of big RealPage systems. But just like any software, and Microsoft's probably no different, when you sign up for these softwares, you use like a sliver of the features. Well, all we do is today we're at 90,000 units. So that's what we're currently doing the monthly accounting for. We've got about 150 people, 90,000 units. And a lot of times we're just helping clients leverage the software to be more scalable. Simple example, AppFolio's got a feature called Smart Bill. Instead of having your vendors forward you the bills, they get forwarded direct to AppFolio, and they've got some AI image recognition software that can kind of read 4 of the fields, right? So it kind of pre-populates some information. And then you can see it all in the system, and it's a lot easier to go through. If they're not leveraging online payables, a lot of people are still cutting paper checks. A lot of people are still calculating what they have to pay their owners in a spreadsheet in Excel. There's constantly issues. Excel's great, but a lot of manual error. So a lot of scaling for us is just showing them how to leverage the software to be more efficient.
Excellent. Yeah. So you're teaching them to fish, not just going fishing for them, and helping them to scale their time and their energy from this manual task that they're already doing. That makes perfect sense.
Yep.
What as far as other big ones that kind of come to mind that people really, love about what you guys do?
Some of this stuff seems basic, but it's just critical, which is response times. That's an easy win. Two is just, I think when you're in the real estate industry, like people always say, like a bookkeeper, a bill comes in. Yes, I can get the bill into the system. But when you are a real estate investor and it's all about NOI, then your accountant, if they're picking GL, general ledger items above the line or versus below the line, that's changing NOI. And when you go to sell that asset and they say, send me the report from Appfolio that doesn't require any manual manipulation, just send me the report. Well, if you got a bunch of expenses above the line that were non-recurring below the line items, all of a sudden your NOI looks lower. And sure, you can say, oh, well, no, look, you got to add that back and this and that. But like, nobody wants to hear that on the other side. They just want a report that works. Or, when it comes to repair and maintenance versus capitalized, like if you're capitalizing a bunch of stuff that should have been, or expensing a bunch of things that should have been capitalizing, all of a sudden you're bringing your NOI down. And so again, sure, I can make manual adjustments, but getting it actually right. And when you're doing the accounting for 90,000 units and you're constantly seeing different bills, and it's just easier to, you get better, and that's why we're so hyper focused on real estate.
I couldn't agree with you more. Like the NOI is so important for lenders, for buyers who are looking at your deal, and for you to make sure that you have accurate numbers. They call them open cycles, right? All the things that if you're putting in bad information or bad input, it's going to be a poor outcome or a less than ideal outcome. And so making sure that you are putting the things in the correct order, in the correct way, so that you can at the click of a button have those reports that are accurate. It's going to help you, go in the right direction, and also see the anomalies, right? I mean, talk about just like preparation and or year over year, planning to see, oh, this is out of sorts. I've had owners of multifamily properties that we've worked with from brokerage standpoint, where we see something and we say, what's going on there? And like, like your utilities are up by 30%. Oh, I guess I didn't realize that until we looked at those anomalies. And now there's a leak. There's multiple leaks going on, or the property manager was doing something they shouldn't be doing, because, you can start to see patterns, right? So talk about how you're going to help them recognize patterns and take action.
Yeah. And a lot of that is just not having, it's two things. One, you didn't put a budget in the system. And there's no rocket science around budgets other than the who of who's got to get it done, right? Or the service, right? But going back to, who, not how. And somebody's got to get it done. So we help our clients get the budgets in. But then two, somebody's got to run the reports and actually look at them. And so that's another thing with the software. Almost all these softwares, you can set up automated reports. A lot of people aren't doing that. So that, every Monday or once a month, whatever the cadence is, we send the automated reports to the owner that says, month over month, year over year, those trends, budget to actual. And then, we actually look at those reports and discuss. And this just kind of comes back to like, you got to actually look at your numbers. And if you're unwilling to do that, you're taking a risk. You got a blind spot as the owner.
Absolutely. I love it. And by the way, we're talking with Mark Kappelman, rea.co. He's CPA, CFA, but he's also a real estate investor who is focused on helping those that are in, real estate or property management or property owners that are looking for services to scale, to have crystal clear accounting, get your investors paid on time, and has the focus on that. What other questions I haven't asked you so far I should ask you, and then we can maybe shift into the some capital gains tax geek out tax flow strategies.
Yeah, I think a lot of people, property managers, constantly asking, how should I how many bank accounts should I have? How should I have this set up? You know, that's always one. It's like, look, you need to have one account for your main business. So for your money, where your management fees go, one account where all the rents and expenses get paid out, and one account for security deposits. You know, so we almost tell every client, look, at minimum, you should have 3 bank accounts. And if you jumble it all together, the risks are just going to be higher that you're going to get it wrong when it comes audit time. That's probably one of the most just kind of basic ones. And then really just, I go back to, we do run into some people that are running their businesses on QuickBooks. And it's just, QuickBooks is great for so many businesses and they've got an amazing product for a reason, but it's not for property managers with 100+ units. It just doesn't have any of the functionality. And if that's you and you're doing it successfully, great. But I would highly encourage you to, for somebody that did that early in his career, because again, you know, I come from personal experience. Like I was doing it all in QuickBooks. I finally upgraded and it was just like, it is light years better. Yeah, it's a little more expensive, but I mean, it's so worth it.
The value is there. Yeah, it makes sense,
Yeah.
Mark. So now let's shift into, DSTs, right? Before the show,
Yep.
we were talking, and you actually know both of them, being that your background, but a lot of people get them confused with the Delaware Statutory Trust. We also have the Deferred Sales Trust. Now, before the show, you're mentioning, hey, I've explored some of those. So I'm curious, what's your understanding of the Deferred Sales Trust? Is what we specialize here at Capital Gains Tax Solutions. And then let's talk through that challenge you were thinking that it was, and let's see if we can solve it here with the debt over basis.
So I didn't look into the Deferred Sales Trust. I looked into the Delaware Statutory Trust. So
Okay.
do you want me to go down that route, or does
go down that one? We'll go that one, and then we'll weave in how the Deferred Sales Trust can help. Yeah.
So we sold an asset in November of 2023, and our equity to debt ratio was about, let's just use 2080. That's about exactly what it was at, 400K to 1.8 million. So pretty darn close. Okay. And trying to figure out what to do. The problem with that time of the year was that, you know, debt to equity, you know, like because rates have gone up so much, the debt service coverage ratios, I could no longer get, well, let me take a step back. To avoid 1031, you need to not only redeploy all the cash, but you need to redeploy all the debt. And so if you want to redeploy 1.2 million of debt, you can't just put down 400K, because that would be like getting 75% leverage, 1.6 million for, and it was more like we were going to have to come to the table with like 600 to 800K of cash. And we didn't really want to do that. So now all of a sudden I had boot likely, right? Even if I put all my cash in, I was going to have boot. And so, and boot is a taxable thing. So then I started looking all the way around Delaware Statutory Trust. I looked into that. And then when I learned in that process, again, my novice learning, so you can correct me, hopefully, it seemed like those products are even less levered than a normal multifamily deal. So I was even have to put in more cash. And if I didn't, the returns just weren't what I wanted them to be. And I had a business partner and he was like, no way. So ultimately the deal we ended up doing was a deal where we got 900K of debt, and instead of the 1.2 we needed to place. So, you know, and we placed all the cash. So, or we placed most of it. So we're going to have some boot on the debt replacement in the amount of like 250, because we weren't able to replace all of it. So I hope people caught that, but that's what happened.
Yeah. Okay. So I'll make sure I unpack that a little bit more and we kind of solve this for people. What Mark's referring to is it's called debt over basis, and Mark's exactly right. And a 1031 exchange has got to be equal or greater value that you purchased for, and also replace equal or greater debt. So for example, if you're selling an asset that has a $3 million sales price and has $2 million of debt, well, then on the next property that you purchase must be at least a $3 million sales price and have at least $2 million of debt. What we're seeing is interest rates are going higher and higher, and debt coverage ratios for banks are getting tighter and tighter, meaning they're not loaning as much. And so Mark is probably finding himself in a situation where A, he doesn't want to take on that much debt. B, the banks aren't being as flexible as they used to be, and C, he's in kind of an inverse situation where he has mostly debt and not as much equity because he did what's called a cash out refi, which is great when you do it because it's tax free.
Yeah.
But then when you find yourself when you're selling, a lot of that can get recaptured and or just catch up with you, right? And then it's considered boot. And so what we do here at Capital Gains Tax Solutions is focus on building what's called a capital gains tax exit plan, and we use multiple strategies to solve different problems. So just like you have a hammer to hammer a nail and a screwdriver to screw a screw, they do different functions. And so, Mark, here would be the strategy. You ready to kind of geek out on this for a second?
Yeah, please.
Let's do it. Okay, so what was the exact sales price of the asset?
It was 1.8 million.
Okay. And then what was, you said the exact debt was 1.2, is that right?
Yeah, 1.25. It was 1.25.
Okay, let's use 1.2 to keep it simple.
Okay.
What was the adjusted basis approximately?
Approximately 900 grand.
Okay, got it. All right. So in this scenario, as a sample, if Mark were to do a pure 1031 exchange, he needs to buy something for 1.8 million or greater, and he'd have to have about $1.2 million of debt or greater on that asset. So this is what what I would consider what's called it's kind of like a lopsided exchange or a lopsided 1031 because you have mostly debt and not enough equity. So here's the step. Step one, we send all of the funds with my company, Capital Gains Tax Solutions, to a qualified intermediary that we work with. It's our #1 strategic alliance, and all the funds go there, and we set up what's called the best 1031 exit plan. The best 1031 exit plan. Now, Mark, it depends on what you're trying to do. Now, most of our entrepreneur clients are trying to sell high and buy low, and they're also trying not to go into debt when it doesn't make sense, and they're also not trying to get hammered with tax. We call these the three aspects of a best 1031 exit plan. You have debt flow, you have tax flow, and you have cash flow. Most people are just focusing on cash flow, and they have some idea that they have this tax flow situation. That's a challenge because you're in 1031, but now their debt's out of whack and they don't know how to connect the dots. Either way, they know they have problems in each mark, but they don't know how to connect all the dots, right? Mm-hmm. And so we got to first solve for your debt. So we send all of the funds to a qualified intermediary. And then we do a partial Delaware 1031. We call them, because that's all they are, Delaware Statutory Trust. And we do what's called an Amazon zero coupon deal. Okay, these are typically very highly leveraged deals, as much as 80% levered. Okay, in order to replace the debt over basis. Now, in this situation, you do have 1.2 million, and we're going to use a 20% down payment for that, which is 240,000, which is going to eat up the majority of your equity. However, we're at least going to get that debt out of your name. It's non-recourse debt. All of the cash flow is going back into paying the loan off. It's zero cash flow. But in this scenario, all we're using is this hammer for this debt situation. We're going to get non-recourse debt. We're going to replace your debt over basis 1.2, because the challenge becomes as well, if you don't do that, is that 1.2 over a $900,000 adjusted basis is considered ordinary income tax, right? Which is even worse. So that would be 300,000 of ordinary income tax. So instead, we're going to replace all of that debt over basis by putting about $240,000 down on this Amazon coupon deal, which you take a partial 1031 interest into. Any questions on that first part so far?
Why do you call it Amazon?
Well, it could be Amazon, it could be FedEx, it could be different ones, but it's just a really, really AAA rated typical tenant. It could be Ford Motor. These are most of the times we're doing Amazon, these huge warehouses that Amazon.
Oh, I see. It's actually a distribution center.
Yeah, this is a distribution. Yeah, it's a better way to put it, right? But the key, it's important though, because the key is that that person who's leasing it is investment grade, right? Amazon, one of the biggest companies in the world. Yeah. They're not going to not pay their lease, right? And this is part of why the banks will give that high 80% LTV. Sometimes it's 77, sometimes it's 70, or sometimes it's 80, 85, 82, 83, depending on the deal. But the point is, you, Mark, only have to put 240,000 to get a disproportionate amount of debt replacement, which is the 1.2 million. Now, that's one way you could do it. However, you might say, well, Brett, I want more of my equity.
Well, and can I throw one more thing in there, Brett?
Yeah.
Which is, I still got another 160K of cash that I got to do something with.
Yeah. Yeah. I'm going to solve for that in a second. Okay. Right? That's the cash flow. But I want to make it a little bit better now, right? The only thing you really have to solve for is the debt over basis. Now, your debt over basis, remember I said 1.2 million was the debt. $900,000 was the basis. So you really have a $300,000 debt over basis. So actually what we're only going to do right now is replace your debt over basis. And so we're going to do 300,000 by 20% at 60K. So Mark, how would you like to only have to put 60K of your 400,000 into that Delaware 1031 Amazon deal? Now you have the other 340 that you could put into what's called a deferred sales trust, defer all of your capital gains taxes, okay? And be able to use that equity if and when you find a deal. Okay, so this is what we're going to do. We're going to put 60K into that Delaware 1031. We replace that 300K debt over basis. The rest of it, though, if you were to do a rest of a 1031, you have to replace that rest of that debt. But in this scenario, we're able to put the rest of the equity, about 340, into the deferred sales trust. And because it's a partial installment sale and a partial 1031, you're in a 100% deferred state at this point. So we do these constantly. It's called a bifractured 1031 exchange. And so you don't have to replace the full debt, only the debt over basis, and you don't have to do a full 1031. And this is the beauty of the deferred sales trust. It allows you as the entrepreneur to buy whenever you want with that 340, to not have to go into debt that you don't want to go into, and to diversify the wealth. A lot of our clients are putting into T-bills or hard money lending for a period of time until they find a deal. So I'm going to pause there. But if anyone wants to learn about that, you can go to capitalgainstaxsolutions.com. You can also go to experttaxsecrets.com to learn more about that. Mark, what questions do you have?
I wish I would have met you before, we did the deal. What's the timeline on that 340?
So the beauty of the deferred sales trust, and we call this the number one reason to use it, is what's called optimal timing. There is no timeline. You never have to do a forced 1031 shotgun wedding, like 45 days, 180. So you can invest when you want, how you want, as long as it's investment or business, into any asset that you want, and you're never forced into any time frame, because our parents taught us to sell high and buy low. And I'll tell you a deal of a client of ours. We sold a $13 million car wash. We helped them sell an exit into the deferred sales trust. Their basis was $4 million. They're selling in Taxafornia, and they're making out a 40% tax on this. And they said the same thing. They're like, this is about a year and a half ago. They're like, Brett, this doesn't make a lot of sense on these deals. We don't want a 1031. And I said, great, let's pay off your debt, let's defer your tax, and let's diversify the rest of the wealth until the market shifts. And sure enough, the market is shifting now. They've been mostly in liquid investments, T-bills. They've been in hard money lending, making 10% that we can get out in about 30 days. And that's the beauty, Mark. You might find a deal tomorrow. You might find a deal in 6 months. You might find a deal in 2 years. If we remember the 2008 crash, it took 3 years for the real estate market to finally hit bottom. 2008, it began, essentially, and 2011 hit bottom. And so there's no timing restrictions on the deferred sales trust. And you can partner with the trust. And this is the other part that's going to blow your mind. Most people would say, this is way too good to be true, Brett. But I'm gonna throw it at you here. You can get what's called a new depreciation schedule. A new depreciation schedule, but you can get up to 80% of that depreciation schedule the way we structure the deferred sales trust through a joint venture partnership with the trust. And this is like the reason we wrote the book, Building a Capital Gains Tax Exit Plan. And we're on a mission to help people understand how to do this, Mark, because sort of like what we're talking about before, a lot of the folks that have been in the industry, all they do is talk about a 1031. They just bang that drum, right? It's sort of like those traditional folks that are only using QuickBooks for their property management, stuff. Yeah. And like, don't only use the 1031, but we come in and say, guys, yes, you can use a 1031. In fact, we'll use a partial 1031 Delaware statutory 1031, but we'll also use the deferred sales trust, which is like Netflix versus the old Blockbuster method. And we execute this on all the time. So yeah, what questions do you have, Mark, on this one?
What's the magic number of the 20% of the 300?
Yeah. And so in regards to that, remember there was the debt over basis. You have 1.2 million. Your basis was 900,000. So that's 300,000. And so that's what the debt we have to replace. You must replace it if you're going to do this strategy. And so we're going to take 20% of that, which is 60K, right? Because it's an 80% LTV deal. So they say we already have this Delaware Amazon deal structure ready to go. And Mark, you can partially 1031 into it with just $60,000 down payment. And that will replace that debt of 300K. So now you've checked that box off. So no more ordinary income tax on that boot. And then the rest of it, you can just put into the deferred sales trust on this scenario, 340. So that's how we got to that. Does that answer the question?
Yeah, it does. It does. Yeah, no, I wish I'm a CPA. I've never even heard of this. I haven't heard of this. So this is awesome.
Appreciate it, Mark, for
Yeah.
for you being on here to go through that scenario with us. If people want to learn more, go to capitalgainstaxsolutions.com and you can schedule a no-cost consultation. That being said, Mark, are you ready for the lightning round?
Yeah, of course. Let's do it.
All right. Knowing what you know now, if you could go back to your 25-year-old self, what's the one golden nugget to make sure to tell yourself to do?
Buy real estate sooner.
Question number two, what's the number one book you've recommended the most in the past year?
10x is easier than 2x.
Question number three, what are you most curious about right now?
Real estate tax.
Yeah, me too. Let's see where that goes. The estate tax is reshifting in 2026. That's another thing that's a big challenge. And we can solve for that as well. Next question is this. What's the number one leadership quote or theme that you strive to live by?
Always working, always playing.
I like that. Second to last question. If there's one big domino that you can knock over using AI, what is that domino and how are you going to use AI to accomplish that?
The biggest one, every one of my clients says the holy grail is insights to help me save money. Just like you were talking about with why do we have leakage on the utilities? That is not an easy problem to solve. Whether you've got good reports or budgets, those things help, but it's not. That's what we want to use AI to get to the holy grail. And we know that if we can save our clients more money, then we're charging them. One, they're paying for a service, but I mean, if we can beat that, then it's a no-brainer to work with RIA.
Got it. One tag onto that. What's the number one way you're using ChatGPT right now?
Writing letters, writing emails. We summarize every client call. And so we use a call transcriber, but then, it summarizes it for you, but sometimes the summary is not good. You could just drop the whole recording into ChatGPT and say, hey, summarize this with the key takeaways. Boom, it spits it out. And those are our meeting notes. Coming from a guy that used to be on phone calls trying to remember exact everything and write notes, and then you can't read your notes. And hey, what did Brett say at minute 34? And everybody racking their brains. We don't have that anymore.
That's amazing. Thank you for sharing that. The last question, Mark. After all your success, helping all the people you help, what would you say is the number one practice or habit that you practice to stay centered in your values and stay encouraged to charge forward to reach even higher heights?
Every single morning, I pray, I gratitude, and that's what keeps me centered. I just make sure I know what I'm thankful for, and that life's bigger than just business. And that's how I do it. But every single morning, I'm super consistent.
Amazing. Mark, I want to thank you for being on the show. I want to thank you for using your gifts of being a leader of big groups and people. I encourage you to keep doing that, inspiring people to take action with their numbers, with their life, with their income, as well as continue to be open to learn new things like the deferred sale trust, man. We had a lot of fun kind of going back and forth with you on that. For our listeners who want to get in touch with you, would you mind one last time? What's the best place for them to find you?
The website, rea.co, not .com.co, or you can find me on LinkedIn, Mark Kappelman, RIA, REA, and I'm pretty responsive on there. I'm pretty active. So both spots, schedule a call with us on the website or DM me on LinkedIn.
Amazing. Thank you, Mark. And also thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast. We're also streaming Expert CRE Secrets podcast as well. Thank you for all the listeners out there on our YouTube channel, on our podcast. Hey, we believe most high net worth individuals and those who help them, sometimes they struggle with clarifying their capital gains tax deferral options, and not having a clear plan is the enemy. And using a proven tax deferral strategy such as the deferred sales trust, sometimes the Delaware statutory trust, sometimes the 1031 exchange is an amazing way for you to exit highly appreciated assets. So you can create and preserve more wealth, defer millions of dollars of capital gains tax, eliminate estate tax. By the way, as a quick side note, it also works for cryptocurrency. We just had our first NFT deals last week. It works for business sales. It works for primary homes, all of which do not work for a 1031 exchange, but the deferred sales trust works for all of them. You can go to capitalgainstaxsolution.com to get started. You can also check out the book on Amazon, Building a Capital Gains Tax Exit Plan. If you want to connect with me as well, all of our stuff, all of our YouTube, our podcast, our book, you can go to brettswartz.com. That is our kind of our funnel hub where all things come together. So go to brettswartz.com. Appreciate everyone listening out there. Please rate, review, subscribe, share this with someone that could help today.